Hi everyone, welcome back to another session on strategic financial management. So today we'll be discussing about operating budgets and working capital. The previous session last week, I gave you an introduction to the budgeting system, and we also did a few budgeting systems. Today we'll be learning about the operating budgets. So here I will be discussing the theoretical part related to the operating budgets, right? Only the theoretical part. And this is what you'll be tested for your assessment as well. There's no calculation, nothing related to budget when it comes to your assignment or assessment. You will only have the theoretical area. You'll be only tested with the theoretical area when it comes to budgets. However, if you go towards the last slide, the slide just before the last slide, this recording has the calculation. So you can watch it, right? This recording has the calculation related to the operating budget. So I've done a session. I've calculated all these operating budgets and also taught how to do the financial statement. So if you wish to learn how the calculation is done, you can watch these recordings. Clear? And also there's another session, which is session 14, that is also a recording. You can watch it. I advise you to watch it so you'll get a better understanding about the operating budgets. So this session speaks more about the incremental budgeting system, which you can watch. So I advise you to watch it, please, especially session 14, because this is about incremental budgeting and you really want it. You have to be very thorough with this area because task 3 is basically into incremental budgeting system. Right. So today we're going to learn about the operating budgets. We're going to learn about the operating budgets. Here we're going to learn about sales budget, production quantity, material usage, material purchases, and direct labor. So let's see what sales budget is about. So a sales budget is a financial plan that estimates the expected sales revenue. Remember, we're talking about budgeting, right? This is not the actual result. This is not the actual cost. We are only talking about budget, which means you're projecting, you're forecasting. You have to be clear with that. So a sales budget is a financial plan that estimates the expected sales revenue of an organization over a specific period of time. Clear? So this involves forecasting the demand for the company's goods or services and assessing whether this projected demand can support the achievement of reasonable and feasible profit targets. So this budget serves as the foundation for many other budgets, such as production, cash budgets. Everything else starts after the sales budget. Clear? Next, we have production quantity budget. Production quantity budget. Now, this budget outlines the number of units that must be produced during a specific period to meet the projected sales demand while aligning with the company's inventory policies. Right? Meaning, in order to keep the inventory at a specified minimum levels and prevent excessive accumulation. You know, when there is too much inventory, it's a problem. When we learned ratio analysis, we learned about it. And then also we have excessive cost. When there's too much of inventory, too many inventory, there is a holding cost. Meaning this inventory needs to be stored somewhere, which is a cost. Yeah. So production quantity budget, they outline the number of units that must be produced during a specific period of time to meet the projected sales demand, making sure that they align with the company's inventory policy. So production quantity budget is closely linked to the sales budget because they incorporate the expected sales volume and desired inventory levels in order to determine the optimal production quantity. This is about production quantity budget. Next, we have material usage budget. Material usage budget. So the material usage budget, now they are often paired by, or they're often paired or followed by. So after the material usage budget, you usually prepare the material purchases budget. So they're always together, right? They're always together. So the material usage budget, they estimate the quantity and cost of raw materials required to meet the company's production targets. Again, remember, estimation, because we're talking about budget. So this budget is directly based on the production quantity budget. So you have to understand, first we make the sales budget, then we proceed to the production quantity budget, then we proceed to the material usage budget, then we move to the material purchase budget. Clear? So all these are interconnected, right? All these are interconnected. So you need to prepare the other three before you move to material purchase budget. So material purchase budget is developed based on the material usage budget. And this budget, material purchase budget, they outline the quantity and cost of raw materials that needs to be purchased during a specific period of time. Right? What does the material usage budget do? They estimate the quantity and cost of raw materials required to meet the company's production target. This material purchase budget, they outline the quantity and cost of raw materials that needs to be purchased during a specific period. So usage is about meeting the company's production target. Purchase budget is about purchasing the raw materials. Clear? So this budget ensures that there is enough materials, or there's materials that is available to meet the production needs, ensuring that they align with the company's inventory strategy. So material purchases budget, they take into consideration the quantity of raw materials required for production and the desired ending of inventory of raw materials, the beginning. So beginning meaning opening inventory, closing inventory, the inventory amount, the raw materials that is required during the specific time period, everything will be taken into consideration in the material purchase budget. And then finally, we have the direct labor budget. Now, what is a direct labor budget? Now, direct labor budget is a component of the master budget. So what is master budget? I will explain. This is the master budget. Master budget is where you collaborate all the budgets together to make a master budget, right? So direct labor budget is a component of the master budget that estimates the total direct labor hours and costs required to meet the company's production targets. You have to remember, this budget helps determine how many labor hours are needed and the associated cost of labor based on production volume. You need to budget all this. Forecasting the cost, so we can plan things ahead. So it is critical for business, especially in manufacturing and service sectors, where labor is a significant, they play a significant role in the company. And it is a big part of the cost for the organization, especially when it comes to manufacturing and service sectors. So proper planning ensures or will ensure that the company has the right workforce in place to support production without incurring unnecessary labor expenses. Here, this is about direct labor budget. And this image, as you can see, This image has all the budgets in one slide, in one image. Now, this is the master budget flowchart. This is called as the master budget. So master budget, this shows how different individual budgets are interconnected. Clear? So all the budgets that we prepared before, the reason why we prepared is to prepare a master budget. So once the master budget is prepared, this will lead up to the budgeted financial statements. So the preparation of all these budgets, you prepare all these budgets, then it leads us to preparing the budgeted financial statements. Budgeted financial statement. So let's look into this. So initially I told you we start from the sales budget, right? So this is the starting point of the master budget, the sales budget. So as I said before, it forecasts expected sales in unit as well as in revenue. So they are the ones that drives the entire budgeting process. As you can see, they are the ones who are driving the entire budgeting process. And then based on the sales budget, we will prepare the production budget and the ending finished goods budget. And then we have the direct materials budget. Now, this is derived from the production budget. Then we have the direct labor budget, also derived from the production budget. And then you have the other budgets, and then you have the cash budgets. This combines info from direct materials, direct labor, overhead, selling, admin, everything together. You prepare the cash budget. And the final output of this master flow budget is the budgeted financial statement. So the budgeted financial statements will be prepared by using all the above budget. So they'll be preparing the budgeted income statement, statement of comprehensive, we learned in the annual report. So budgeted income statement will be prepared. Budgeted balance sheet, budgeted cash flow statement. So once we prepare the master budget, we will be able to prepare the budgeted financial statement. And now we are moving on to working capital. Now, working capital is the difference between a company's current assets and current liabilities. So before we move on to before I move to the formula of working capital, first let's understand what current assets and current liabilities are. So current assets, they are the resources expected to be converted into cash or used up within 1 year. Right? So current assets, it could be cash, inventories, account receivables, marketable securities, any type of resources. But the condition is they should be able to be converted into cash or used up within 1 year. They are called as current assets. More than 1 year, they will be fixed assets like furniture, equipment, machinery, vehicles, buildings. They come under fixed assets. Why these assets like building, vehicles, they cannot be easily converted into cash. It's going to take some time. Yeah. Next, we have current liabilities. Now, current liabilities are the obligations that is due within 1 year. Right? They are the amount of money that a company owes, and they're due for payment within a year. They're called as current liabilities. More than a year, like a long-term bank loan, they come under fixed liability. Or you call it long-term liability. Right? Or you say non-current liability. You have different words that can be used. So anyways, remember current assets, current liabilities, both within 1 year. This is a condition, right? Now let's move on to working capital. Working capital is the difference between a company's current assets minus current liabilities. So the working capital formula is current assets minus current liabilities. So the working capital formula tells us the short-term liquid. So the working capital formula, this measures the company's ability to meet short-term obligations. Whether they have current assets, whether they have enough current assets to meet the current liabilities. This is the purpose of the working capital. Right? So you have positive working capital, negative working capital. What is positive working capital? When the current asset is more than the current liability. This is positive working capital. Current assets is more than current liability. This indicates the company can cover its short-term debts within its short-term assets. This is a sign of good financial health. Great. Now you have the other extreme, which is negative working capital. Right? You have the other extreme, which is the negative working capital. What is negative working capital? When the current liabilities are more than the current assets. Now, this may signal liquidity problems due to poor asset management. Right? So it is very crucial to have a good working capital, a positive working capital, as this plays a vital role in the day-to-day operations and overall health, financial health of a business. Clear? This is about working capital. And then we have few importances of working capital. Liquidity management helps in decision making. Addition in the value of business helps in earning short-term profits, helps in the situation of cash crunches. Perfect investment plans improves creditworthiness of entity, good reputation of entity. Liquidity management. We learned about liquidity ratios, remember? So liquidity management. Now, maintaining adequate working capital ensures that the company has enough liquidity. So if there is a positive working capital, this means that the financial health, the liquidity of the company is great. So there is effective and efficient liquidity management of the company. So that is the reason why it is important to identify, to find out what is the company's working capital. Next, informed decision making, helps in decision making. So accurate working capital data allows management to make well-informed decisions. Yeah, so if it is a negative working capital, they can find out, okay, why is it negative? What should be improved? What can be done to improve? What can be done to make it a positive working capital? Again, if it is a positive working capital, right, what did we do right? Yeah, what did we do right? And also these positive or negative, this data can be used to make decisions regarding budget, regarding investments, regarding other operational management strategies. Next, addition in the value to the business. Now, efficient working capital management enhances a smooth operation of the organization. Right? So you have to have a good or adequate working capital management. Next, helps in earning short-term profits. What does this mean? Now, proper utilization of working capital, if you're able to manage your working capital efficiently, this will allow the businesses to take advantage of short-term market opportunities. And they will be able to gain short-term profits. Next, helps in the situation of cash crunches. What does this mean? Helps in situation of cash crunches. So what do you mean by cash crunches? I'm trying to figure out an example for you to explain the short-term profits. I'll come back to that. Okay, let's look into helps during cash crunches. So when there is limited cash inflow, a healthy working capital provides a financial sort of a sponge, that can prevent insolvency or the need for emergency financing. And number 6, perfect investment plan. How investment? How can we do investment? When you have surplus working capital, this can be used by the organization to invest in short-term projects to gain short-term profits. Yeah. Next, improves credit worthiness. So a strong working capital position demonstrates a good financial health of the company, which as a result enhances the company's credit profile. And it is easier, if you have a good credit worthiness, if you have a good reputation, it is easier to secure loans. And also you can take, you can request favorable credit terms from the suppliers. And finally, enhances business reputation. So an example for a short-term profitability. I'm trying to figure out an example to explain related to how we can, earn a short-term profit. Okay, let's take a bakery, right? A bakery may use its extra working capital to buy ingredients at a discount before a holiday, right? Say for an example, there is a vacation, there is a holiday coming up, okay? Oh yeah, let's say it's the Christmas season, or it is the just say it's a winter season, or it's a holiday season that will be coming up within another 2 weeks. So during the holiday season, it's quite difficult for us to stock up the inventory. So when you have extra working capital with you, you have enough money with you, right? Your working capital is positive. So you have some money that is extra. What you can do is buy in bulk at a discount before the holiday rush. Now, this will help the bakery to prepare more baked goods, sell more, and earn more profit quickly. Yeah. Especially when it comes to this Christmas season, you'll be able to earn a bigger profit if you're able to manage your working capital effectively and efficiently. So these are the importances of working capital. A few importances of working capital. Is that clear? Now let's move on to the working capital cycle. This is one of my favorite. I love teaching working capital cycle. Just take a few minutes and go through this. See whether you understand anything. This is a working capital cycle. And remember, whenever you come across the word cycle, it means what? Continuous. Like Kaizen, continuous improvement. And you also have something called PDCA cycle. Plan, do, PDC, check, act. It's cycle. Cycle means continuous. It is continuous. It keeps on moving. So take a couple of minutes to look into the working capital cycle. See whether you understand anything related to this. Maybe you understand. It's easy actually. So WCC, working capital cycle. Now, working capital cycle is the time it takes for a business to convert its investment in inventory and other inputs into cash from sales. So it initially starts from this spot, cash or bank overdraft, meaning when you start a business initially, you will have some cash left with you, or you may take a bank overdraft to fund the operational activities of the business. So you may have cash in hand, or you may take a bank overdraft. So this cash or the bank overdraft is used to purchase raw materials, Sometimes you may pay cash immediately to the supplier and purchase the raw materials. You call these cash purchases. You call these cash purchases. So you pay the money immediately. You pay the money then and there and purchase the raw materials. And you have the other option. Instead of paying immediately, businesses may purchase the raw materials on credit. Now, this creates a liability and you call them trade payables. So trade payables, another term that we use for trade payables are creditors, meaning the company owes them. So you have cash or bank overdraft. So you have two options. One, you purchase raw materials. You do it, you call it cash purchases. So you pay then and there and purchase the raw materials. You have the other option. Maybe you don't have enough cash to purchase. Then what do? You purchase on credit. You call this credit purchases. Now you have the raw materials with you. So raw materials are then transferred into production. These raw materials now comes to the position of work in progress. Now, this is the step that represent the manufacturing process. And then what happens after work in progress, after this phase ends, then these products, these raw materials will be completely transformed into finished goods. Now they are ready to sell. Finished goods are ready to be sold. So again, you have two options. One, or the first option, cash sales. What does cash sales mean? Cash sales means you sell and you get the cash from the customer then and there. You call it cash sales. And you have credit sales. What does credit sales means? The customer purchases the goods now but pay later. So trade receivables are also called as debtors. So debtors means the customers owe the company. Creditors is the opposite. The company owes the supplier. Trade receivables, debtors is the other extreme. Right? So trade receivables. Later, the trade receivables may or may not settle the cash. So when you get the cash, then you settle off your debts, go with your operations, and then you start again. Raw materials, trade payables, again and again, this is a continuous flow. So a business aims to minimize this cycle duration, meaning they try to do this process faster, because faster, the faster it is, more liquidity. Yeah, more liquidity. So they don't delay payables. They try to settle it off quickly. And again, customers, they try to collect the cash from the customers quickly, right? They may give discounts, right? They may try to, push the trade receivables to settle the payment on time. Again, trade receivables, as I said, they may or they may not pay the cash. There's a risk. There is a risk here. So if the trade receivables don't settle the amount, which usually happens in companies, you call it bad debts, right? So bad debt. So companies, what they usually do is they will be providing a percentage, right? They will be, how do I put this into words? You call it provision for doubtful debts, right? Provision for doubtful debts, right? This is something similar to depreciation, meaning allowance for bad debts. So provision for doubtful debts means the company, they estimate a percentage of the amounts of account receivables that may not be collected. Yeah, it is recorded as an expense. So for an example, say there is $10,000 worth of accounts receivable. So every year they will be calculating 2% or 5% or 10%, depending on the company policy, right? Some companies will go for 5%, 2%, 10%. They will be allocating this amount as a provision for bad debts, a provision for doubtful debts. Clear? So this is the working capital cycle. And then finally, we have this image, which is related to managing inventories. So this image gives us a clear outline of the key procedures and techniques for managing inventories, which are essential for ensuring that inventory levels are optimized. So as I said before, inventories should not be too high or too low. If it is too low, problem. Too high, again, problem. Yeah. So you should be able to have a proper inventory management system. Right? So if it is too high, what happens? There will be cash flow issues. Yeah, maybe you're using up cash, you're just stocking up, and you will have problems in running your daily operations if you have too much inventories. What does it mean, too much inventory? Because you have tied up all the cash in purchasing inventory. And again, holding cost. There is another problem. If it is too low, this can disrupt production because there will be demand, but no raw materials to produce the products. Again, a problem. So we need to manage inventories efficiently and effectively. Clear? So they say first is budgeting futures. So these are certain techniques that can be followed in order to have a proper management of inventories. Number one is budgeting future demand. Budgeting, forecasting future inventory needs. So you can research, you can find out, okay, what are the trends? What are the future trends? What are the future sales trends? Are there any seasons that might boost demand? What are the market conditions? How is the customer spending? Yeah. What's the inflation rate? So you're budgeting the future demand. So if there is a high demand, if you forecast a high demand, then you may stock inventories. Yeah. And you will be able to stock, you'll be able to plan, okay, how much of inventories needs to be stocked. Budgeting future demand. And then financial ratios. So you can use ratios like inventory turnover ratio, which will measure how often inventory is sold and replaced. So you can take this financial ratio into consideration and see the inventory turnover ratio. You can see how fast the inventory is sold. So if it is sold faster, what does that mean? There is a good demand. If it is sold slowly, if it is taking a long time for the inventories to be sold, then what? The demand is low. Yeah. So these financial ratios will help assess the inventory efficiency, and you will be able to make informed decisions. Next, recording and reordering system. So you can use an inventory tracking system like reorder points, right? Reorder points. For an example, let's say this is your inventory storage. Okay, it's awful drawing. Let me take this. Okay, that's better. Right. Let's say this is your inventory point, inventory reorder point. What does that mean? So you will be having stock. Okay, so you'll be having stocks here, right? All these are stock. I should have used a different color pen. Okay, let me make it longer. Right. So the company will be using up all these stocks. Okay. So when the company reaches this point, the reorder point, the company needs to reorder, order inventory. So when the company reaches this point, this is a time for you to reorder, and then you fill it up. Again, this gets empty, comes to reorder point, you fill it up. So this is a system, one of the system that you can follow, right? And then you have levels of control. So you can also apply different control levels for different inventory types. So you have something called the ABC analysis, not the ABC that we learned before. The traditional costing system, no, not that one. This is ABC. This is a different, this is a system for inventory management, right? This ABC system is completely different from that one, right? This is not the costing system. So inventory, this ABC inventory system is a method of classifying inventory based on the importance and value of each item. So you have high value, strict control. So you have A, which is high value, strict control. Then you have B items, which is in the moderate, and C items, which is in the basic control. So this gives you a view ensuring that the high value items receive more attention and lower value items are managed with less details. That is the ABC, right? ABC system. So you have A, B, C. So A is high value, meaning they will be receiving more attention. And C is the lower, the basic control. This is the ABC system, right? And then you have the inventory management models, which is like the what's that? Economic order quantity, EOQ. Now EOQ, there is a formula, EOQ formula, right? When you calculate the EOQ, you will be able to find out, the optimum order quantity to minimize the total cost. Meaning, what is the amount of inventory that needs to be ordered? Let's put it this way, EOQ, this calculates, I cannot recall the formula. Right, this is the inventory management formula or the system that used to determine the optimal order quantity that minimizes the total cost of inventory. Meaning it helps the businesses to balance the cost of ordering inventory and holding inventory. Right? So EOQ, they will be taking ordering cost into consideration, holding cost into consideration, and the demand into consideration. Right? EOQ, this is the formula. EOQ equals to 2DS, which means D, and S means ordering cost per order. And then this will be in, and you have the holding cost, H here. This is the EOQ. Right? This is the EOQ. This is one of the model that you can use. And yes, you also have something called the just in case. Just in case, right? Just in case system also can be used. Just in case inventory system, it's a traditional inventory management approach where business maintain a higher level of inventory to ensure that they meet demand. Right? They always maintain high inventory level. You call it buffer stock, right? The buffer stock. This is like the extra inventory that serves as a buffer. That is JIC, just in case. I remember I was teaching this particular chapter to ordinary level business studies students as well, just in case. This system was there in their syllabus as well. And then finally, we have just-in-time inventory management. Yes, just-in-time. Again, just-in-time inventory management will not work for all organizations, right? Just-in-time inventory means inventory is ordered and received only when needed. Meaning the customer orders the product, right? Customer demands the product. That is when the company will order the inventory. This is called as just-in-time inventory management. And just-in-time inventory management, again, it's not going to work for all companies, right? Just-in-time inventory management, you have to have an efficient management system, right? You should have reliable suppliers, because as you order the goods, as you order the raw materials, the suppliers should be able to meet the demand. Yeah. So the organization who follow just-in-time inventory system, they aim to minimize inventory levels. They aim to minimize the cost involved in holding the inventories in the company. So they receive the raw materials only when they are needed in the production process, right? So this system reduces the cost associated with holding inventory and aims to improve efficiency by aligning the ordering of inventory with actual demand. Clear? But there is disadvantage. As I said, there is disadvantage. You need a high coordination, right? There's trust, reliability, everything. And you know, when it comes to JIT, you're completely supplier dependent, right? You're completely supply dependent. So that is why you need a reliable source of supplies that can deliver the required goods quickly. So why, if the supplier fails to deliver on time, your production will stop. Your production will be disrupted. Yeah. And then the organization that follow JIT, in case of a demand spike, say there's a sudden demand, what happens? It will be difficult for you to supply the products to meet this demand. So those are a few disadvantages, but again, there are advantages as well when it comes to JIT, like reduce inventory cost, sometimes no holding cost, sometimes. Yeah. And there'll be good cash flow management in the company. There'll be good cash flow management in the company. Why? Because you order the raw materials only when needed. And there's also less waste. You call this lean manufacturing. Lean manufacturing. Yeah, lean management. Right? You call it lean management. Now, the prime purpose of lean management is to reduce waste. Right? Lean management is a methodology that focuses on maximizing value by minimizing waste. So organizations that follow JIT, they also follow lean management system. Okay. So that's about managing inventories. And again, if you need to learn more, if you're interested in seeing how the calculations are done, you can watch these recordings and you can get a clear understanding on how to prepare a master budget and how to prepare a budgeted financial statement. So let's go through a review again. So here we learned the theoretical area relating to operating budget, sales budget, production quantity budget, material usage budget, material purchase budget, direct labor budget, and then we learn the master budget. Then that will finally, or the outcome of the master budget would be the budgeted financial statement. And then we learned about the working capital, importances of working capital, the working capital cycle, and managing inventories. Thank you so much for attending the session today. I'll see you tomorrow. I'll be discussing the assignment sketch. I have uploaded the summer sketch on the LMS. You can go through it, you can download it, you can take a printout and be ready for the discussion tomorrow. I have made it very clear. I have given step-by-step instruction on how to do your assignment. So if you follow my instruction, great. Okay. And then, yes, gentle reminder, please get the approval for your companies. You have to, before you proceed with your task, before the first task number 1, you need to get the approval. I have to approve. So if you select 2 companies, you have to tell me what companies you selected. And at the same time, when you're telling me what company you selected, make sure that you also attach the annual reports. I need to go through the annual reports. Sometimes you will not have the data to calculate certain financial ratios. So I need to analyze. I need to find out whether you have the required data to calculate the financial ratios. If not, you're going to be in trouble. So that's why I want the annual reports as well before you go ahead with your calculation. So make sure that you get the approval of the companies. And again, no two students can select the same company. Right? I will not approve it. And then again, another warning. The companies that has been extensively used by your previous batches, your previous, previous batches, your seniors, I will not approve those companies as well. And when you're selecting a company, make sure that these companies are registered with the stock exchange, with the LSE, Colombo Stock Exchange, anything, Qatar Stock Exchange, any country. It's up to you to select. It's up to you to decide. But make sure that it is registered with the stock exchange. If not, you will not be able to access their financial data, annual reports. Yeah. So you'll not be able to. For that reason, you have to ensure that these companies are registered with the stock exchange. All right, then. Thank you so much for attending the session today. I'll see you tomorrow with the assignment discussion.